Further ado, let's bring on our first speaker. As I said, he will do a talk called DAO Treasury Management and Performance. So give a huge round of applause for Andy Pavia.
Hey everyone, super happy to be here at ETH Barcelona presenting the DAO Treasury and Compensation Performance Analysis. This was an analysis created by the Palmera team. Before we get started, quick introduction of what Palmera is, the DAO orchestrator. We are a one-stop platform for DAO operations and tooling. We essentially help Web3 orgs manage safes, integrations, automations, and credentials all in one place. And we've essentially been looking at how DAOs are doing with what's happening out in the market. We've definitely gone through a very wild ride. It all started where Mr. Jay Powell and the Fed changed the monetary policy, started going very hawkish. Then soon after that, we had Terra collapse. I think we all remember that. Closely after that, we had FTX. You know, everything was gone. With that, a lot of things went down in the market, not great for us. And then after that, we have Mr. Gensler right here, seeing securities everywhere. So that's been quite a ride for us. However, even with everything that is out there, even with the market not moving, we're still out here building stuff. And the beauty about decentralization is that it doesn't matter what's going out there. As long as the infrastructure is there, the blockchain is there, we're going to be here just building. So that's fantastic. Now, the really bullish thing is that if you analyze if you just look at on-chain, essentially data of instantiations of multisigs across a bunch of different EVM chains, you can see that there's more and more safe multisigs being instantiated on-chain, which is super bullish. Before we deep dive into the analysis, I just want to go quickly over the methodology and some disclaimers. I'm not going to go super deep into how we do things just because we don't have that much time. But essentially, we're looking at on-chain information from safe multisigs using tools such as Dune, ChatGPT, obviously a lot of Jupyter Books, Python. We're using DBank for everything related to DeFi positions, and we're essentially aggregating it all, plotting it, and running some statistical analysis on it. So if you like data, I hope you're going to like this talk. Some disclaimers: we're as good as DBank is for essentially DeFi positions. As we know, there's an ever-expanding set of smart contracts out there. They're all their own financial instruments, and they can only keep up with so much. So small disclaimer there. Another small disclaimer is that we're treating each multisig as its own entity. It might be that there's many of them connected. We're not connecting that. So that's just quick disclaimers. Now let's go over the first questions. What are the assets that the DAOs are holding? So that's an interesting question, but we're going to segment it a bit further. The first thing is that we're going to separate it between DAOs that hold, or multi-sigs that hold 5 million to 50 million, and the ones that hold more than 50, okay? Second thing is that we're going to essentially define 3 market cycles: bullish, which is in green; bear, which is in red; and then sideways, which is in yellow. On all the graphs, you're going to see the end date. So when you see the end date, you can think of that market cycle. Then we're going to classify tokens according to 4 different categories. First one is just Ether, native token to Ethereum. Then we're going to have native tokens. So when I say native tokens, I want you to think of okay, if we're analyzing, let's say, Balancer, you are thinking of the Balancer token. The next one is stablecoin. So here you have USDT, USDC, DAI, BUSD. And then everything else that is not those 3, we're going to refer to ERC20 tokens. We know that stablecoins and native tokens are ERC20 tokens, but yeah, that's the nomenclature. So let's look at the first graph. This is essentially the token analysis. So we're looking at the dollar values across the different market cycles for entities or multisigs that have 5 million to 50 million. I would like to point on the bull market that a lot of it was essentially in native tokens, and they also had a lot of ERC20 tokens. And you can see how the dollar value goes, declines super heavily in the next 2 cycles. If we compare this to essentially entities that have more than 50 million, I want to point out 2 differences here. The first one is look at essentially the native tokens. The positions here are way heavier, and also you can see that in the last sideways market cycle, they have smaller positions in ERC20s. That means that they're keeping mostly their own native token, some stable coins, and some Ethereum. Now let's look at the percentage in which each token category predominates. On the other one, we were looking at USD value. Here we're looking essentially, if we grab a multi-sig and we see that it mostly holds its own native token, we classified it as native token, and then we create percentages. So this one is the one that is 5 to 50 million, and this one is the one over 50 million. And I want to show essentially one big difference is that native tokens on the larger ones predominate heavily if you compare that to the previous one. Now, if we look at a stablecoin analysis, we also find a big difference here. This one is the one that is 5 to 50 million. You can see that USDC predominates here quite heavily. USDT is not as prevalent. If we look at the larger entities, you can see that a lot of them are using mostly USDT. So a couple of theories here might be there's just not enough volume for USDC. However, the smaller entities are probably looking at USDC as a less risky stablecoin due to what's happened with Tether in the past. Now, the next question, how have DAOs endured the last cycles from a P&L perspective? And when I say P&L, think value difference within the multi-sig. So this is essentially a box diagram. So what's within the box? The upper edge and the lower edge are essentially the 25 and 75 percentile. And then the flags at the top are essentially the lower and the top percentile. And whatever is outside of the box is essentially outliers. So you can see that from the 5 million to 50 million, on the bull market, most of the entities essentially made money. So you can see there in the value difference. Value difference, think if it's 500, is 5x. During the bear market, the majority of them essentially lost money. There's a couple of outliers that essentially did really well, as you can see by the red dots. And also during the sideways market, a lot of the entities are making money. However, the 50 percentile is 3%. And then you have a distribution that some of them are losing money, some of them have lost all their money. If we look then at just the net sum value difference by period, so this is if you grab all the essentially the multi-sigs and then you aggregate them by total profit or loss and you essentially aggregate together, you can see that in aggregate during the bear market, the smaller entities lost $8 billion, which is insane. They also made, some money during the bull market, but compared to how much they lost during the bull market, it's nothing. If we compare now the box diagram between the larger entities, so the ones that have more than 50 million, we can see that essentially both of them, if you look at the 50th percentile, they're both very close to losing 84% of their treasuries, which is catastrophic. And if we look at the sideways market, essentially the bigger entities are doing much better. If you look at the 50th percentile, 33% of them are up compared to the smaller entities, the 5 to 50 million entities. So that means that for some reason, the larger entities are able to recover or do much better in this sideways market. Might be kind of like a power law. Essentially, the bigger, right now everyone is slowly getting into the market, and they feel more comfortable injecting money into the larger entities. And if we aggregate the 50 entities, right, so if we aggregate essentially the money that they made or they lost, we can see that they lost $30 billion, the larger entities, compared to $8 billion of the smaller entities. Smaller entities is a much larger set. Now, the next question. Is there a correlation between transaction volume and assets under management? So for this, we made a little ratio. We have yearly transacted volume, so on-chain transactions, over the total value locked. So we created essentially this ratio to try to figure out how active these entities are. And we were asking the typical question of like, okay, is the entity that is trading a lot more often and is moving positions a lot more often, are they actually more performant or not? Does more activity lead to more losses? And is there any sort of connection here? So this is a distribution of the ratio that I just described. You can see that you cannot have anything below 0, obviously. And then we see a wide range here on the sort of ratios that we have. Funny enough, and I thought this was very curious, the red one, 2021, that's the bull market. Obviously, a lot of activities. On the smaller entities, we have some that were essentially trading 45 times their TVL, which is very, very aggressive. But during the bull market, there was a lot more, during the bear market, so the green color, they were even more active, which I think that is pretty curious. And then during the sideways market, they're not trading as much. This is essentially a k-means cluster analysis, where on the y-axis we have the value difference, or what we're saying P&L, and on the x-axis we're looking at essentially the ratio. Again, the ratio delimits how aggressively they were trading, and you can see that at least from the 5 million to 50 million entities, the ones that didn't trade as much were able to have a better performance in terms of P&L. And there's a lot of them that traded quite a bit, and then they lost money. And then if we look at the entities that have more than 50 million, there's one difference here, is that essentially they're all trading way less. If you look at the scalar of the ratio, on the previous slide it got all the way to 150. Here the scale is 45. So they're just essentially trading a lot less, probably because they're holding illiquid assets or assets that are not as liquid, so they cannot trade as often. And if we look at the k-means analysis, there's one green one over there that you can see that it traded a ratio of 10 times, so it essentially moved 10 times its own total value locked, and it did essentially 10x. So this is an outlier of someone that's really, or a group of people that are really trading and still being able to capture a very good P&L. However, if we look at the correlations, there is no statistical, essentially, the measure is not statistically significant, and we can't say that trading more leads to making less money. So yeah, that's not something that we can say that is statistically significant. Yeah, so some conclusions. In terms of like activity, the average ratio was consistently greater than 1 for the entities that are between 5 million and 50 million, indicating that there is high activity. The activity for the larger multi-sigs was less, and we cannot say there's a clear correlation between essentially the ratio and performance. The multi-sigs themselves are highly correlated to the market. From a token composition, there seems to be increased focus in risk management in the later periods, and you could say there's some diversification. However, that diversification from a correlation perspective on the P&L doesn't really hold true, but just more from like each token has its own risk, operational risk. You got different teams, so essentially if you have different tokens, you are decreasing that individual risk for each token. And we've seen that essentially USDC among the smaller entities is more widely used. And with that, we're about to launch a report where we essentially go a little bit deeper into the methodology, and the sort of tools that we use, and with essentially with more conclusions. Yeah, so please scan it. Would love to hear what you guys think about the report. And if you can also give us a follow, we do a lot of essentially analysis into DAO tools, what DAOs are doing, performance of the market, and essentially different techniques that DAOs or DAO tools are using. Yep, and with that, I would like to open it up for questions.
Hello. Yeah. So, in the bull market, we saw a lot of DAOs increasing their treasury value, mainly because of the increasing prices of the native token.
Correct.
And we also saw a lot of DAOs disappearing because of in the bear market or in the bull market, they didn't manage to convert their treasury position more into a stable, in a good balance.
Yep.
And that was the main reason why many of them disappear. So, well, or some of them, they didn't survive. At the same time, when you have a DAO and your token is not as liquid as you would like to, you cannot go and just simply swap them into stables one.
Correct.
What is your advice, or what would you say if tomorrow we have a next bull market and there are many DAOs again, maybe doing a tokenomics, and they really want to have this treasury issue that you are very exposed to your native tokens? What would you recommend to not to, well, what would be your lesson learned in this bear market?
Yeah, so that's a really good question. I would say it's two things. The first one is essentially create a future prediction of what your expenses are going to be, right? Calculate for the traditional market cycle, so let's say 5 years. Make sure that out of those 5 years, you have stable coins to essentially be able to pay your expenses. And then leverage your treasury in a smart way so you can still kind of reduce the supply out there of your own native token, because that's how you incentivize your people, and that's how you incentivize the team, and that's how you incentivize contributors. So I think it's essentially you gotta grab a chunk just to play it very conservatively and make sure that you can keep your operations running, and then be smart about when you can essentially get some liquidity from your own token without affecting the vector of your token in terms of price. Exactly. Yeah. It's a tricky one. Yeah. So I think kind of dividing treasury into chunks and kind of getting people that know how to get yield on certain opportunities where you do the proper third-party risk analysis, I think is the right thing to do. Yeah.
When you were measuring the P&L of the different states, which hypothesis?
Sorry.
When you were measuring the P&L of the different states, which hypothesis did you do in terms of the cash flows that come in and come out? You just look at the value at the beginning with everything and the value at the end with everything, or?
Yeah. Right now it's value difference. I think there's a lot of things like, let's say you need to, well, first of all, we're taking a couple of assumptions. First of all, these ones are DAOs, so they're not moving money outside of the on-chain perspective, which for a portion of them, it can be not true, right? It's still a model, because you will need to essentially be able to classify deposits, transfers, and withdrawals to be able to compute a true P&L. That's why when I say P&L, I mean value difference. But I mean, you would need to essentially be able to create the whole mapping from a financial perspective to say this is a true P&L, right? So essentially what we're doing is we're looking at the beginning of the period, end of the period, what's under the control of your multi-sig. And with that, we're grabbing all this data.
So if there's new investments or there's payments of salaries, that's all included there, so it could come from external flows.
Yeah, exactly. Which we could say that the P&L of your organization also takes into account the expenses. But if, let's say, if they're not DAOs and they're using multi-sigs and then they're putting things into centralized exchanges, we don't see that. right? But we still think it's a nice model to kind of see from a high level what's going on and what are some behaviors that we're seeing across these two different sets of entities that we're analyzing. All right. Well, guys, thank you very much for joining. Hope the data was useful.